All right, YouTube. An article just came out saying that 25% of us are going to lose our houses if interest rates keep going up. Now, this is not a funny matter, but I just find these clickbait articles fairly entertaining. In this video, I'm going to tell you everything you need to know right now so that you're prepared for your mortgage renewal when it comes up and what your options are and how not to end up as a statistic as per the Toronto Star article. Hi, my name is Vassil and I'm a chartered professional accountant by training that's a full-time realtor. I've built and invested in real estate right here in Toronto, York region, and secondary markets outside of the GTA. All right, let's put things into perspective. First of all, just over 60% of people have mortgages. That means that close to 40% of people don't even have a mortgage in Canada. So that's number one. Number two, majority of mortgages are fixed rates. So that means that even if interest rates are going up like they are now, most people don't care. The reason they don't care is because their rate is fixed and they don't care until renewal. Now, if they're renewing in the near term, then they're probably more worried. But for the most part, those with fixed rates are currently not worried. Third, those with variable rate mortgages, depending on who your lender is, when interest rates are going up, your payment doesn't necessarily go up. What the banks do is they'll just adjust how much less is going into your principal repayment and they just charge you more interest of your total payment. So therefore your payment is the same, it's just you're paying down less of your debt and you're paying more in interest. The current debate in the real estate industry is whether or not people are going to be able to requalify for better mortgage rates at the renewal, or if they're just going to have to take whatever renewal the bank gives them at the new rates and at their old amortizations. If this is confusing, I'll explain it all with some numbers after. But what all of this means is that the belief currently is, and the statistics somewhat support this, is Canadians took out record levels of debt against their homes over COVID. I mean, February alone in 2022, I think we took out $2 billion worth of HELOCs. That makes you more indebted. So at renewal, that's going to affect your ratios in terms of how much you can borrow. And that may not make you eligible to requalify for a mortgage, and you will just have to accept whatever the bank renews your mortgage at. And that is the risk for your payment to go up substantially to the tune of 10 to 20%. Comment below if you think Canadians are at risk of losing their homes and if you think the number is higher or lower than 25% based on what the Toronto Star is estimating. All right, let's go through a common example with numbers that make sense and are relatable to a lot of people. Let's say you bought a detached home in 2017 for $1 million with 20% down. You had to take on an $800,000 mortgage right here. Rates back then, on average, were 3.62 for fixed. Some were lower, but I'm using conservative numbers. Amortization of 25 years, your payment was $4,000 or $4,000.45. This is to set the baseline. During the last 5 years, had you been making those payments as you were supposed to, you started with $800,000, and then in the end, you paid down over $100,000 in principal, leaving you with $691,000 of principal that's outstanding, meaning that this is the amount you're going to have to renew or requalify for at your renewal now. And you ask yourself, what is my worst case scenario? Let's say you can't qualify for a mortgage right now because of whatever reason. So that means the bank is just going to renew your mortgage right now at a 20-year amortization with whatever the fixed rate is. That means currently at 5%, with a 20-year amortization, your payment becomes $4,500 or roughly just over 10% based on what your current or what your prior payment was. Now, this is your worst case scenario. Now, let's take a look if you can actually qualify and you're lendable. A common strategy employed by those who need to keep their payments down is they renew their mortgages and they extend the amortizations. So they started at 25 years and now they're supposed to be at 20 years, but they're like, you know what, I need to keep the payments again the same as they were or lower, so they just reapply again for the mortgage at this lower balance that they have and they do it at 25 years again. This way they keep the payment pretty much the same even though the interest rate is higher. This is not something I recommend doing because you can just extend your mortgage into infinity, but at the same time I do understand sometimes life calls for these things and you have to do them. Now this is one option. Let's look at the other options. Assuming you can qualify, you can also go for a variable rate. Right now, the spread between fixed and variable is massive, close to 2%. Right now, if you were to get a variable rate with a 20-year amortization, the interest rate is 2.5% and your payment would become $3,600. There's one more option. If you're looking to decrease your payment the most, then you go variable and you go back to the longer amortization of 25 years at 2.5% and your payment is now effectively $3,000. Again, not recommended, but I understand if you need to manage cash, then cash is king and it will be king for the next little bit. But these are just some of the options that you do have at renewal, provided you can qualify for a mortgage. So who's at risk? Well, if you've taken on a lot of debt or if you're at risk of losing your job, you will have issues qualifying for a mortgage. So therefore, you're going to be at the mercy of whatever the bank renews you at, and you're likely going to have a higher interest payment. Now, couple that if you have outstanding variable rate loans, well, then that compounds the issue. If you feel you're at risk, you should get ahead of the issue right now and be proactive. Talk to a realtor that understands this. Talk to a mortgage broker as well to evaluate all of your options. Do some pre-screening right now just to see whether or not you're going to be able to requalify or not at the current high rates. If you're not even sure where to start, feel free to text or email me. I can make recommendations. I'm always happy to help, chat real estate, and help where I can. And I'll see you in the next one.